All right, it's 10 o'clock, so we're going to get started with the webinar. Thank you for everyone for tuning in today. We appreciate all of you, and today we have Rev Up Your Listings in Reverse, which is on how a realtor can help older homeowners list and rebuy a better home using the reverse mortgage for purchase. Today, Robert Ross will be our instructor for this course, and just a couple of housekeeping items before we begin. So first, I have muted everyone's microphones, and then please keep them muted for the duration of this webinar, as well as your cameras as well. In order to take questions from everyone, we will be using the chat feature. So the chat feature can be found with the chat icon on the bottom section. And simply, if you have a question, you can just type in your question, and then we'll be taking questions from the chat at certain points throughout the presentation. Now, some questions may be asked that will be covered later in the presentation. So if we see those, we'll just let you know that we'll be covering that topic future in the presentation. And so we hope you stick around. And we will have a break around the midway point of this presentation. It does go from 10 to 12:30, but we will stay longer to answer any questions that you all may have. And without further ado, I will now have Robert Ross take the floor.
Good morning, everybody. Thanks for tuning in. This is my first live stream during this situation that the country's going through, and I had a pretty good beard going. I had to shave it all off, though, so a little bummed about that, but hey, I'll grow another one. So one of the things I wanted to talk about just really quick is that although it's obviously impossible to find any positives about what's going on right now in our country, or even the world for that matter, one of the things that I've thought about to myself is that while we're under this situation that we're all in together, what an opportunity to actually sit down and actually focus on building your business. And that's one of the things that my partner and I, Ryan, have always struggled with. In other words, we find ourselves sometimes as loan officers or even owners of companies and realtors for that matter to get caught up in the daily tasks of what your job is. And we divided these things into two different ways. Basically, you can either work in your business or you can work on your business. And that's the struggle, right? Is to figure out working in the business or on the business. So obviously during this time, you're going to have some downtime, probably less interaction with customers and whatnot. So the only positive I could possibly see out of this whole situation is this gives you some time to possibly work on your business and think about ways to when we do get out of this situation we're in, how we can go out there and approach the market and generate some new activities by figuring out ways to be more efficient, ways to market better, and like I said, working on your business. So this is a good time to talk about it. And this class that we do is all about that. Really, it's to help you generate more activity, more listings, by way of understanding how our retired homeowners are going to operate, how they're going to retire, how they're going to sell houses and repurchase new homes. And so this reverse purchase product is a great way for them to do that. So we'll be talking about the reverse mortgage for purchase today, obviously, but towards the end of class, which in my opinion is the most important piece, this is where we're going to dive into exactly how to market to these folks, to these retired homeowners, to generate conversations so that way you can identify needs of possibly them wanting to list, to rebuy, or they need a reverse mortgage to stay. So this is what this class is really all about. I've been in the business for, gosh, almost 15 years now, doing reverse mortgages exclusively, and my business partner, Ryan Kleiss, as well. So we focused on the reverse mortgage for a long time. And then, more so recently, the reverse mortgage for purchase has really taken off. And as a matter of fact, it represents about half of our book of business right now of the loans that we're completing our reverse purchase. I just closed 5 transactions myself, all in a row, reverse purchases, 5 different clients, 5 different realtors who have taken our class in the past. And of course, the agents got the listing and the buying opportunity. So all these clients were trying to figure out ways to sustain retirement, own a home, and not have a monthly mortgage payment, and do all these things with just what they had in front of them. And the agents that have taken the class saw this as an opportunity. They went back and revisited these clients that they have talked to in the past and said they had a solution. And of course, they turned it into transactions. So these transactions are out there, guys. I just want to make that super clear. They're out there. And we're going to show you today at the end of class with a few different softwares how to go out and find these listings. So I highly recommend you make it to the entire course. I know it's hard to sit down for 3 hours or 2.5 hours, what have you, for a webinar, but if you can somehow make it through it, that's great. Grab some coffee as you get maybe a little tired and whatnot. I'll try to keep it entertaining as much as possible. It is a live stream, of course. Usually we do these in person, and I usually thrive better in a live class environment because I get the feedback and the feel of the audience, which is cool. But without further ado, let's go on and get this done here. So
Thank you, Robert. So just we got a couple more people. Thank you for turning off your video. We really appreciate it. And as I was saying, we will be taking questions through the chat, and the chat button can be found on the bottom. I think that just the bottom center. Chat button looks like a dialog bubble, and if you click that and you can type in your chat, we'll address it at certain points in the presentation. And this webinar will be recorded, so I'm not sure when North San Diego County Association of Realtors will be putting it up live, but it will be put up as a podcast, hopefully at some point. All right, without further ado, Rob, you can continue with the presentation.
all righty, thank you. All right, so let's talk about the topics today. So of course we're going to talk about what is a reverse mortgage. The reverse mortgage product has been around for a long time. The earliest product that I read about was in the 60s, and those were the products that were done non-FHA. In other words, there was the private sector, there was insurance companies, small home savings and loans, banks and whatnot, providing a type of a reverse mortgage rather. And so we're going to talk about predominantly today the HECM product, which is an acronym. So if you want to write that down, by the way, you should have a copy of this PowerPoint. You can print it out, follow along on your computer screen, whatever you got to do. You can take notes, of course. So a HECM is the FHA insured product. That is a home equity conversion mortgage, HECM. You won't hear me use that term too much. You'll hear me just use the regular reverse mortgage term, but just know that when I say HECM, we're dealing with the FHA insured reverse mortgage. So we're going to talk about what is a reverse mortgage. They've been around for a long time. We're going to clear up a lot of the misconceptions. We're going to talk about obviously the benefits of one. We'll spend a little bit of time talking about the traditional refinance reverse mortgage product. And then of course, immediately dive right into the reverse mortgage for purchase. Essentially, they are the same product. They're underwritten the same way. The loan amounts are calculated the same way. One is used for a consumer to stay in the house they're currently living in for the rest of their life and not have a monthly mortgage payment and access equity in the home. The other mortgage for purchase product is a product where someone would have a down payment either by net equity from the house they're selling or cash in the bank, and they would put that down on the home, and we would find a reverse mortgage into escrow, and they would close escrow with that reverse mortgage, and they got themselves a new home with no monthly mortgage payments. So that's the two different distinctions. So we're going to talk about that, of course, today. We're going to talk about, like I said, the reverse mortgage versus the purchase product. So we'll make those clear distinctions for you. Now, the other thing that we want to talk about, of course, is there a market for this product? The short answer is, of course, there is. And I'm going to go through why that is, what's going on with our retired homeowners. Is a homeowner more likely to use a reverse mortgage to stay in their home, or is a homeowner more likely to sell their home and buy the next home with a reverse mortgage? It's starting to lean more toward the people that are using it to buy, and I'll explain why that is in just a little bit here. We're going to talk about the myths and the facts about the product. The product has been around for a long time. So some of our silent generation, this is the generation that's older than our boomers. They remember the private sector products from back in the day, from the 60s, 70s, and 80s. So those products were the wild, wild west. In other words, you didn't know if you were getting a lender that would be a part owner on your house or share an appreciation on the home. It was all over the map. And then in the late 80s, FHA came along and created what we have today, or HUD rather created the FHA reverse mortgage, which is the safe product. So we'll make the distinctions of that. Some of those myths from those previous private products got spilled over into the FHA HECM product. So I want to clear those up as well today. Let's see here. We're going to talk about calculating loan amounts. So this is a very important area because every loan amount is different for every aged borrower. Now, with the FHA HECM product, the youngest borrower needs to be at least 62, okay? So 62 to 63, 64, 65, and all the way up, every single age is a different loan to value calculation. Now, I've been in the business for 15 years, like I said. If you were to ask me right now, hey, Rob, what does a 73-year-old get on a home that's worth 650? What's the loan to value factor? And I would say I have no idea. And you're probably respond with, well, what have you been doing for 15 years, right? Well, every age, like I said, is a different calculation. Not to mention, in a fluctuating interest rate market, that also puts a factor into that whole equation. And of course, home values as well. So we've actually created an application for your phone that you can use to help calculate these loan amounts. It's for purchase predominantly, but you can use it for a refinance product as well. But the way the app works is you put your purchase price in, borrower's ages, and hit calculate. It'll tell you the down payment and the loan amount required to make that transaction work. We'll be covering that today in the later part of the class. And of course, the big piece, like I said, this is for the end of the class. I'm going to show you guys out there how you can start generating some activity right now without barely doing anything more than what you're doing right now. In other words, you have customers that you've already talked to in the past, or that are retired homeowners that are sitting there, and maybe you didn't say the right things, or maybe they didn't say the right things to cue up or spark up conversations as to what's going on behind the scenes with their finances, with their house. And so we're going to show you some talking points. We're going to show you some softwares and how to find these people. And we're also going to show you a software that is, you're able to take like a high priority prospect that you may have in your book of business now that has talked to you about listing. Maybe they're a retired homeowner, like, hey, I do need to list my house. I'm just not sure when, or I'm not sure where I want to buy or what to do. I'm not sure about capital gains and property tax transfers and all these things. Well, we have a system for you that you're able to take that client and drop it into our system, and we will reach out to them through mailers, emails on your behalf. That's going to give them the information they need to make a wise decision to sell their home. And best of all, you are the agent that's sending it out, and you're top of mind with them when they do decide to list. So that's something that we provide to you. So just stick around till the end of class. I want to make sure you guys take advantage of that, okay? All right, let's move on here. So let's talk about what is a reverse mortgage in a nutshell. Well, let's talk about it from this point of view. So like a regular mortgage, when you have a reverse mortgage, you get a monthly mortgage statement. And on that monthly mortgage statement, it's not going to have a place to make a payment or do anything like that. What it will show you is, it'll show you what your balance is, of course. It's going to show you any available proceeds you may have that you can use for your retirement needs. It's also going to show you the interest that's due for the month, and also the mortgage insurance that's due for the month, because it has FHA insurance on it. If you basically treat it like a reverse mortgage and do nothing and take your mortgage statement and file it away, what's going to happen is the interest and mortgage insurance that was on that particular statement for that month will be deferred to the next month, and therefore your balance will be greater the next month. Hence the term reverse mortgage. The way you can receive any proceeds out of that reverse mortgage that you have in place on the house you're living in. So let's say you have a $600,000 house, and based on your age, you qualify for 50%. So that's a $300,000 loan amount. Maybe you have a small mortgage balance on your house. Now this is what I'm talking about here is a regular refinance reverse mortgage where someone would stay in their house. So let's say you have a $100,000 mortgage and you qualify for $300,000. The first thing we must do is pay off all liens on title. So we're going to pay off what you owe, the $100,000. But you qualified for $300,000. That means you have $200,000 left over. the $200,000 you have left over, you can receive in a couple different ways. The first way is you can receive some of that money the first year as a lump sum. Now, I recommend doing a lump sum of cash only if you have a good need for it. And I'll explain why that is in just a few. The next way you can receive the money is through payments sent to your house or you're wired into your checking account every single month. There's a few different types of payments. The first payment is called a tenure, and that's spelled Tenure. This is a payment that is predetermined based on life expectancy that will be sent to your bank account every month for as long as you live in the property. You can live up to 150 years old, and that payment's still going to show up, regardless if the house is upside down, regardless of your balance. No matter what, that payment will show up. That's called a tenure. Now, the payment is not going to be as high as another style of payment, which I'm going to share with you now. The other thing is, like, if I say, hey, that 10-year payment is $2,000 a month for the rest of your life, and you may say, well, that's not enough. I need more money per month because of this expense or this issue that I have or this bill, right? You can say, I want to do a term payment. In other words, you can say, I need $3,000 a month. And I would say, okay, that's fine. Out of that 200,000, you can receive that 300,000 for X amount of months. And once it runs out, you are now out of reverse mortgage proceeds. That's called a term payment. Okay, so there's two types: tenure, which is a set amount predetermined upfront for the rest of your life, or a term payment, which is a amount that you choose, and I'll tell you how long you can receive that payment for. The next way you can receive the money is in the form of a line of credit. This is my favorite part of the entire loan. The reason being is because when you have a line of credit, you haven't borrowed the money yet, and I like that. That means you haven't started the interest clock on those funds when you take possession. The other thing I like about it is if you need to get money, all you have to do is make a request, usually via telephone. They'll verify some security measures for you, and they will wire that money straight into your checking account. So if you need $5,000 for this thing or the other, you want to remodel your bathroom or do whatever, that's great. You make a request, they'll wire the money in your checking account. That money goes in your checking account. You can spend it as you will. That money that you do pull will become part of the balance bucket, what you already owe. So that's where you'll start accruing interest on it. So that's why I like that feature, because if you leave it in the line of credit, you haven't borrowed it, and it's not accruing any interest for you. So that's a great concept. Now, obviously, if you have a need for a lump sum of cash up front, that's great. I would probably interview that borrower a little bit and talk about, okay, well, what are you trying to do with it? Well, I'm going to pull out $10,000 and go to Las Vegas and play blackjack. I would say, bad idea. This is your home equity. You need to focus on your retirement. If you said to me, well, I want to pull $10,000 at closing to remodel my bathroom, I can justify that. You're adding to the value of the property. Makes sense. It's going to make you happy. I can deal with that. So it comes down to every situation, how the extra money that you qualify for. But the line of credit is a great feature. We'll talk more about the line of credit feature in just a little bit once we get into the purchase side. But that's how a typical reverse mortgage refinance works on that regard. So one of the reasons why people get this loan is because they can qualify for it. And that's a huge thing right there. A lot of our retired homeowners are on Social Security alone. So that could be a $1,500 payment that they get every month from Social Security. To go out and get a $300,000 or $400,000 mortgage with only that kind of income is next to impossible, because you got to have perfect debt ratios, not to mention you got to have some pretty stellar credit to take advantage of the great rates we have today. So more times than not, I would say our borrowers have pretty decent credit, but very little income. So the fact that they can qualify for this loan is why a lot of people get it. They need access to equity. They need access to purchase loans to help them buy that next property. So the fact that they can qualify on a Social Security income alone is a huge benefit, okay? The way we qualify people on these loans is very simple. What we do is we simply add up the costs of the housing, which would be property taxes, homeowners insurance, an HOA fee if applicable, and we add those all up, And then we also want to make sure they have some extra income for the incidentals like medical expenses, gasoline for their car, cell phone bills, car payments, whatever's reporting on their credit report. And so we make sure they have all this stuff. Once all these numbers add up and it's under or at your Social Security income, you qualify. And believe it, more people qualify than not. Even if they're short on their income, we can then start to do what's called asset dissipation, where I can take a cash asset they have and divide it by their life expectancy and bring that into the equation as income. Or the actual reverse mortgage proceeds themselves, we can do a asset dissipation to help qualify them. So pretty cool underwriting as far as that's in regards to that. We definitely have more of a make sense type of loan. This is a manually underwritten loan. They're out, these underwriters are trying to get these loans through. They're not trying to disqualify them. Their goal is to try to make it work somehow. And that's where it comes down to working with professionals that understand the rules of HUD, because even sometimes these underwriters don't understand exactly the rules. And they put conditions out there on these loans that, hey, I may challenge. And I would say 50% of the time, Ryan and I challenge these guidelines, and we come up pretty successful on overcoming the issue with pure common sense. And that's a lot of how these loans are written. So the fact that you can qualify with a lower FICO score and have limited income is great for both people trying to access equity in their home or trying to buy their next replacement home. So pretty cool there. Now, of course, starting in 2009, the reverse mortgage for purchase product comes out. And that was a pretty exciting year, at least for me. I was already in the business at this point in time. I was doing a lot of reverse refinance products. So whenever I would talk to a real estate agent about this product, I was kind of like, shunned upon, if you will. And I understand, because if I'm doing a loan for somebody who has an issue in their home, and now they're thinking, well, I either have to list my house or do a reverse mortgage, the chances are they're probably going to take a reverse mortgage, because the idea of moving after living in your home for 35 years with all your stuff that you've collected and memories in that house can be a little bit of an emotional transaction. So maybe a reverse mortgage might be an easier path. So they would opt in to do a reverse, and there goes a listing for an agent. That's not very good. I apologize for those loans I did prior to 2009, but I definitely helped a lot of people stay in their home and have a better retirement. So I'm proud about that, of course. Now, 2009 comes along, and now Congress passes that we can do reverse mortgage purchase loans. So that year, I probably did about one reverse mortgage for purchase. 2010, I probably did about one or two that year. Fast forward to 2020, half of my pipeline, if not more than half of my pipeline, I think my entire company pipeline for that matter, is reverse mortgage for purchase. So that's huge. The reason why this is happening is for a couple of reasons. The first one is that this loan that we talk about, this HECM product, has gone through many, many changes over the last 10 years. The biggest changes that we have seen has been loan amount reductions. So if someone said to me, hey, Rob, I owe $400,000 on my house, it's worth $680, I'm 70 years old, can I get a reverse mortgage? And I would say most likely not, because you owe too much. In other words, the loan amount that you qualify for is not large enough to pay off what you owe on title. And that's the problem, because they're trying to get rid of their mortgage payment to sustain retirement and live in that house comfortably. That's where the conversation needs to change. And I would simply say, okay, unfortunately, you don't qualify for a reverse mortgage in the home you're living in today. But if you were to go out and buy a house for maybe $600,000, I can do a reverse mortgage on that, and you can put down the net equity from the house you sold as a down payment, and you can live in that house without a mortgage payment. So that's exciting for the real estate community. Our own industry, due to our changes, is starting to create more listings for people who would like to have a reverse mortgage and stay in their house. So when you're out in the farming, door knocking, however you come across your clients, when you're dealing with a retired homeowner and they're telling you, hey, I may want to just stay and do a reverse mortgage, let them, maybe come back to them in 20 days and see if they were able to qualify, because there's a good chance they didn't qualify. And that's your opportunity to say, hey, look, I know you didn't qualify for a reverse in this house. I do have another option for you, and that's going to be listing your house, getting your net equity out, and using that as a down payment on the replacement home. It's a little bit smaller in value, and put it in reverse on that property as a purchase loan. And you still get your goal, which is living in a house, no mortgage payment, and most likely it'll probably be a better home, right? Maybe it came from an investor that just flipped it, a turnkey property. During that transaction, you're able to purge out a lot of items and get into a situation where you're starting to feel a little less burdened in your retirement. So it's definitely a good thing. Most, I would say 99% of the reverse purchase transactions that I've done have been very successful and a positive effect on the actual homeowner themselves. So that was a great year. 2009, that product came out as a purchase loan. I was able then to start talking to the realtors and explaining how this product could help their clients, help them get more business. So pretty exciting time. Now with these loans, of course, the down payment is probably one of the most important factors in addition to the income. The down payment must be verified. Typically it's coming from the house they're selling. So they would sell the property, and after that house closes, then the net proceeds would be wired to the new escrow, and then the new escrow would have a reverse that would come in as funding, and that would finish off the transaction. So the down payment must be seasoned and verified. So if it's coming from the net equity of the home, simple. It's equity from the other home. If it's coming from a cash account or an investment account, we gotta show where it came from and have at least 2 full bank statements showing no large deposits with that money seasoned in the account. So 90 days typically is what we're looking for as seasoning. So even those people that have sold their houses maybe a year ago and they haven't repurchased yet, and they're planning on just renting the rest of their lives, but they have $200,000-300,000 in their account left over from the house they sold. Well, this is your opportunity to go back at them and say, hey, look, instead of renting and paying rent, why don't you take that equity that you have after you sold your property last year and go buy a replacement home with a reverse purchase? At least you can own a house in a market and have it appreciate over your lifetime and have something to pass on to the children later on, because you can't pass on a rental, right? So that's a pretty cool thing to go back after those people as well and help them get back into the real estate market. So 2009, cool year when that product came down. All right. You guys have seen the commercials out there. I know you have. They're on the TV all day long. You see Tom Selleck out there selling reverse mortgages. Henry Winkler back in the day. Our company had Steve Garvey on the TV for a little bit there. And every commercial pretty much talks about one thing, and that is get a reverse mortgage, live happy, and don't have a monthly mortgage payment. Well, this could be an uncomfortable thing for borrowers because they're starting to think, well, if I don't have a mortgage payment, I don't understand how that works. Like, there's got to be some sort of issue there or something I'm not understanding. Well, there's interest on the loan and there's mortgage insurance on the loan. And that's what defers to the balance and makes the loan amount grow over your lifetime. So after being in this business for so long and starting to understand the psychology of my borrowers and what gives them a little bit of uneasiness about the product, if you will, I started asking questions maybe about 10 years ago. I should have started right out the gate, but I was new in the business 15 years ago. So obviously you learn a thing or two 15 years later. So about 10 years ago, I started talking to the customers and asking them the questions. I can tell you're a little uneasy with this loan. Tell me why that is. Give me some concerns you may have about the product. And of course, lo and behold, the number one thing that constantly came up was, I don't like the fact that my loan balance increases over my lifetime. And of course, I can completely understand that. And the reason why is because I have a loan right now that I've had for 15 years on my house. My balance is dropping every month. And they've had a loan for 30, 40 years. It's been dropping every month. It's a completely different mindset, right? So then I would say, okay, what if there's a way you can make a payment on these mortgages? Would that ease your uncomfortness, if you will? And they would say, probably, yeah. And I would say, okay, well, let me see if that's possible. Well, 10 years ago, I didn't know if it was possible. So I started talking to HUD, FHA, servicers of these mortgages, all kinds of people to figure out if this is possible. And the short answer is, of course it is. And the only downside was I didn't have a way to prove or convey this with certainty to my customers. So I had to find that myself, and Ryan as well, my business partner. We had to figure out ways to really make a consumer understand that they can make payments on this thing and control how the loan works. Well, so we went through the loan documents. Believe me, the loan documents are this thick, a lot of pages, right? We go through them, we didn't find anything concrete. HUD wouldn't be willing to give us anything concrete, FHA as well. So we had to do a little bit of reading between the lines. One section of the loan docs is the note section. The note section clearly states that there is no prepayment penalties on these loans, which right there, it clearly states that you're free to prepay this loan as much as you want, whenever you want, or as many times as you want, without having any penalties. So that right there is the golden ticket to be able to make a mortgage payment on these loans. So here's how this would work. A customer would get their mortgage statement and maybe their balance. Let's go back to my original example of someone having a house worth 600 and they qualified for a 50% loan to value, which is 300,000. And they had a $100,000 balance on their house that we're paying off. They have additional 200,000 for retirement needs. So that 100,000, they get their first statement. It's going to show on that statement, you have $200,000 in accessible equity if you want to pull some out. You have a $100,000 balance. And the interest and mortgage insurance based on what your balance is for that month, let's say is $600. If the customer does nothing and takes the statement and crumbles it into a ball and throws it into the round file, you're going to owe $600 more on your mortgage next month. So instead of owing $100,000, you're going to owe $100,600. Very simple. But what if someone were to write a check for $600 and send it into the servicer? Well, guess what? Your balance will be exactly the same next month. So that's how you can make a payment on a mortgage, on a reverse mortgage for that matter. If you pay more than the $600, well, guess what? You're going to start to bring the balance down, right? If I paid $1,200, instead of owing $100,000, I'm going to owe $600,000 or $600 less next month on that statement. So pretty cool. You can control the balance. And once I started giving this information to my customers, you see the walls come down. Oh, I can control the loan myself. So it's not you, the lender, that makes it a reverse mortgage. It's actually me. I choose to not pay it that month and use that money towards something else for my retirement needs. So it's the borrower's control now of that loan. Now, mind you, majority of borrowers don't make payments on these loans because they're trying to get out of having a monthly mortgage payment because they're only living on Social Security. But there are people out there that want to do this. I have plenty of clients doing it now, making payments, doing all kinds of things different than what a lot of the older reverse mortgage borrowers have done in the past. So the product could be used in that regard. So pretty cool stuff, you guys. So making a monthly mortgage payment or not is up to the consumer, and you control how the balance will defer throughout their lifetime, okay? So that was a huge monumental change in how I explain these loans to people. Now, I can't speak for all the reverse mortgage companies out there. However, I can speak for the philosophies of our company. We don't like to sell these loans. We like to educate about these loans and provide information on how to make the loan work very well and be efficient and preserve equity. That is the ultimate goal of this loan, is to have your cake and eat it too, right? Have a loan that's going to help your retirement and that you can control and do things with it that traditional borrowers do not do with. So very cool stuff. That's our philosophy. We try to make the loan work very efficiently. All right, let's talk about the types of homes that you can buy a house with a reverse mortgage. So obviously we know we can buy an SFR, single family residence, very straightforward. Now, if you see there in that last bullet there, owner occupied. So you cannot get a reverse mortgage on an investment property. It's got to be the house that's your primary residence. And when I say primary residence, some people may have a primary residence and a second home, right? So the primary residence is the one that you're living basically 51% of the year. That's where your Social Security award letter is going to. That's where your bank statements go to. That's where your property tax bill goes to. That's where you file your taxes under. That's your primary residence. That's the one you want to do the reverse on. Now, can you have an SFR and get a reverse mortgage and rent a room out? Of course you can. I don't care if you live in the bathroom. As long as you're living in the house as your primary residence, you're good to go, right? Of course, we can do condos. Now, the condos can be a little tricky. This is an FHA loan, so therefore the condominium complex needs to be FHA approved. If it's not FHA approved, there's two routes to go. The first route is we can get the entire complex approved, which takes a little bit more time, more documentation. There's costs associated with it and whatnot. Can be done that way. However, recently, HUD has announced that we can do what's called a single unit approval. In other words, we're focusing on just the one unit that we're lending on and doing a single unit approval to make sure it passes HUD requirements. There still are HUD requirements there. Owner occupancy levels, in other words, investment properties in the community versus owner occupancy. There's reserve requirements for the HOAs. All these things need to be looked at, but it is a easier process to get through for a single unit approval. So those can be done as well. If for some reason we can't obtain a single unit approval or a FHA total community approval, we can start to look at the non-FHA reverse mortgage products, but even those still have guidelines for single unit approval. So either way, we have options for getting over the condominium issues. Now, 1 to 4 unit, that's an interesting topic. So you can buy or own a 1 to 4 unit and have a reverse mortgage on it, which is kind of cool. You can live in one of the units and rent out the other 3 units, for instance. So imagine living in a 4 unit, living in 1 unit, not having a monthly mortgage payment, but generating rental income off the other 3 units. That could definitely help out in some retirement needs. Now that is definitely more for a savvier or type of homeowner, retired homeowner that's willing to go down that road. Obviously, it's not for everybody. It is an option, of course. So SFRs, condos, 1 to 4 units, no problem. Heck, even mobile homes. If you have a mobile home or someone has a mobile home, it's a double wide built after 76. I think it's June or July after 76. Permanently affixed to a foundation. We can do that as a reverse mortgage as well. We can do both fee simple and rental space. Now, if you were to ask me how many rental space mobile home reverse mortgages have I done in my career, that's a big 0. A lot of times the rental agreements that are in place on those spaces are not adequate enough. They have to be a 99-year lease, or the duration that's left on the lease needs to reach the borrower's 150th birthday. So I haven't done one on a leased land yet. I have done quite a few on fee simple. So that is possible as well. All right, so let's move on. Crystal, are you there with me?
Yes, I'm here.
A couple of questions, or you want to keep trucking?
It doesn't look like we have any questions right now, so you can just keep going. And if anyone does have any questions, the chat button is where you can type in a question, and then we can address that at some point in the webinar.
All right, we'll keep moving. All right, move to the next slide. So if you guys have it printed out or on your screen, here you go. Let's dive into our first reverse mortgage for purchase example. This example is based on a 73-year-old borrower. There is a reason why we selected that age, but just remember the entry-level age to get a reverse mortgage is 62, okay? So let's dive into this real quick here. Phones are ringing, sorry about that. Let's say that you find a customer who owns a house currently that's valued at $850,000, and they're looking at selling their home. Now, here's the typical reasons why I see someone would sell this home. The first one being is that they don't want a monthly mortgage payment anymore, okay? That's a biggie. The next one would be the house is too big for them now. It's 2-story, big yard, lots of maintenance required there, all kinds of reasons, right? So this person is trying to figure out, hey, I want to sell, but my challenge is that every realtor that I've met with has ran a net sheet, and the net proceeds I have are not enough for me to go buy something all cash. I don't want to bring a mortgage payment to the new property. And nor do I have any additional cash to be able to go make up for the house that I'm after. So this is where the reverse mortgage for purchase could really help out, right? So let's dive down this this transaction here. So let's say you sold their house, and after they've paid their mortgage off, after they paid real estate commissions, all the normal costs associated with selling a property, the customer nets $400,000 in cash. Now, could they find a house for $400,000 in cash? I'm sure they could. Probably not in the area they're living in. Maybe not even in the state of California at this point in time. There would probably be some sort of smaller condo or SFR that's out in areas that they may not want to move to, or even out of state for that matter. They want to kind of stay where their sphere's at, where their doctors are at, where their families are at, where their grandchildren are at. So they got $400,000 to work with. So let's say you go out and locate them a $500,000 house. I know it's not much more than 400, but there's a reason why we're showing you this idea. Could they buy a more expensive house than $500,000? Of course they could. But I want to give you this example for a specific reason. So let's say they find a house for $500,000, right? And they still need a loan because they only have $400,000 to work with. So let's say, based on their age of 73, I tell them, look, of that $400,000 you netted from the house you sold, I'm only going to require that you use $255,000 of it for a down payment. And that's a good thing, and I'll explain why in just a few here. But they put down the $255,000. I give them a loan for $245,000, right? Now, I know the numbers are, the loan amount is lower than the down payment. However, in today's market, because the rates are so low, I would say that the down payment and reverse mortgage loan amount today is probably about equal. So there'd be about a 50% loan to value on this scenario. But it is changing daily due to the interest rates. So always make sure that we're running accurate calculations. But for this example, we'll just use these numbers here to make it simple. So 255 down, 245 loan amount. What I like about this is the customer was able to retain $145,000 from their previous home that they sold. So that's great. This customer may not have had any cash in retirement, living on Social Security loan, in a house valued at $850,000 with a big mortgage payment. Now they got $145,000 left over. They got themselves a $500,000 home. And on top of that, they didn't generate a monthly mortgage payment. You can now start to see how this can benefit somebody that's in retirement. So, of course, they can make a payment if they want to, but if they choose not to, that's their option. So now they have a house, no mortgage payment, and extra cash in the bank. FICO scores were not considered here. I don't care if you got a 350 FICO score. You know, we don't care if you have the best credit score in the block or 350 FICO score for that matter. If you got a 350 FICO score, the one thing I want to find out is how did you get that FICO score? It's pretty low. It's about the lowest you can have. The only thing we really care about when it comes to credit, you guys, is we care about what's happened over the last 2 years of your life. So I'll give you an example. I had a borrower about a couple of years ago. I love this story because it really illustrates how some borrowers don't understand how they got into the situation they're in. So this particular borrower, in the last 2 years of her owning that property, she had about 3 or 4 mortgage lates all around the same time period within 2 years of me doing her application. So I told her, I'm like, okay, well, you qualify from a number standpoint. You got the age, you got the equity, you're good to go. The only issue I'm seeing here is that you have 4 30-day lates in the last 24 months of your mortgage payment on this house here. You know why that is? And the borrower, started thinking about it, what happened around that time period, and really couldn't come up with any reason why that happened. So I took it upon myself. I'm like, Patricia, can you get me 12 months bank statements leading up to the point to where you had those 4 30-day mortgage lates? And of course, she went to her file cabinet, pulled the mortgage statements out, and we sat at her coffee table and started going line by line, every charge that that she had for an entire year before those mortgage rates. And then lo and behold, about 2 months out from when she first had her 30-day late, there was a large sum of cash charged in her bank account for about $4,500. I said, Patty, what is this charge for right here? And of course, she started thinking about it, going down memory lane, if you will. And she remembered that she had knocked two of her front teeth out as she fell down the stairs in that home. And I said, Patricia, you got it. You found it. This is what I'm looking for. Can you write me a letter of explanation, and can you give me the dental record showing that expense? Within 2 seconds, she handed me the dental bill. We wrote a letter right there at her coffee table, and I turned that into my underwriter, and guess what? Those 4 30-day lates, no problem. We overcame it. That's what I mean by a make sense underwriting type of loan, is that we're able to overcome issues if they have a valid hardship. So we definitely got to address issues. Now, we don't just look at the credit report stuff. If you had credit card lates in the last 24 months, we want to address those as well. But typically, believe me, these homeowners have usually a valid reason. So it's a matter of identifying it, diving in, and getting in there and helping them figure it out themselves, because sometimes they may not remember. The other areas that we look at as well is property tax payment history. We pull the payment history from the county. We pull your homeowner's insurance payment history. We pull your HOA payment history. Probably wondering why we do that. They don't do that on a regular mortgage. Here's why. Because after you do a reverse mortgage, you're not left with a mortgage payment anymore. However, you do have these ongoing housing expenses. So we want to know how you paid those bills over your lifetime. Every now and again, we may get a customer that's got HOA lates. We got to find a reason, or a property tax late. We got to find a reason. So if you have customers right now that are in your database, or that you know of, that may want to do a reverse purchase, and they're on the brink of missing a tax payment or some sort of payment, try to advise them to keep on top of those payments if they're getting closer to wanting to sell to repurchase. So just to make sure we have an easier package to work with. But again, FICO scores don't matter. We do care about the last 24-month payment history. Okay. Moving along. We already talked about limited income. So between low credit scores and a low Social Security or pension, you can qualify. That's a great thing. Okay. Now let's talk about, let me go back here. I went a little too ahead here. Let's go back to previous. All right. Now, if you go back to here, where it says $145,000 left over, right? The customer did not use all their 400,000 they netted. They have 145 grand left over. I always, and I think Ryan does as well, we always ask our customers, what are you going to do with that 145? Or whatever money you have left over. And the customer will say something like this. Well, I'm just going to put it in my checking account and, use it, keep it there for a rainy day. Or maybe I'll put it in some sort of CD, 24-month or whatever type of investment vehicle that's safe for something FDIC insured. Or I wouldn't put it in the stock market, that's for sure. You've seen what that thing's done lately. But maybe something that's, more conservative, or just keep it in your savings account for that matter, or a money market account, whatever you desire, right? I would say that's okay. That's a good idea. I get it. You want to have some cash on hand. But let me talk to you about this. What if you were to take that extra $145,000 and put it down as well? In other words, don't just put down the 255, put down the 145 as well. Put down the entire 400. Put down more than I'm saying, more than what is required. The borrower would say something like this. I don't want to do that because now I have all my cash again. However, I have no mortgage payment. That's great. But now all my cash is locked up in an illiquid asset such as a home, right? If I need to get that later on, I got to go back and get a HELOC, a cash out refi. Maybe I can't qualify because I'm on fixed income, or maybe things have changed during that time period, in the future. So they put down the extra 145. And I would say simply this. Here's what happens when you do this. When you put down the extra 145, are you borrowing 245 from me? No, you're borrowing actually 100,000. The money that you put down extra, I'm going to take that money and set it aside in a guaranteed line of credit that you can pull it back out whenever you need to. Best part is you're not borrowing all that money at the funding of the loan. So therefore you save on deferred interest. And the money that you put down extra will be held in a line of credit that you can pull back out. And on top of that, the money that you put down that's in that line of credit will get a growth rate. In other words, if you put 145 in there, in 1 year's time, you're going to have more money available to pull out. So pretty cool, right? Now, one thing I want to make sure you're clear on is that that money that's in there that's getting that growth rate, that is not a return on investment, right? You're not putting it into some sort of stock or some sort of account where you're getting an ROI or return on investment. What they're doing is they're simply unlocking more equity for you to borrow as the years go by. As the growth happens, it's guaranteed to be there for you to pull out. So like a traditional HELOC or home equity line of credit, when you get one of those, for instance, I'll give you an example. I had one in 2006 that I pulled on my house. And well, 2007 happened and the market went crazy on us, right? The real estate market crashed, stock market crashed, and I had a newborn child and I wanted to put an addition in my house. And I had a loft in my home. I wanted to put a little room in there for him. So I went to go to my line of credit to pull out the cash to do that. Well, guess what? Wells Fargo froze it. And because of the market conditions, they have that right to do so. That's in the note section, typically, of a home equity line of credit. With this line of credit, it's part of the overall package of the reverse. It's guaranteed to be there for the rest of your life. That's pretty cool, despite home values. So even if your home values are going down, you're still going to get growth rate on your line of credit. This probably sounds pretty crazy to you, but there's reasons why. And I'll explain it for that in just a few. But let's go to the next slide where I want to show you how this thing can work, right? Okay, you guys should have this in your presentation or see it on the screen. Let's look at the down payment. So we have our 73-year-old borrower there. You see the down payment is $400,000. The beginning mortgage balance is $110,000. The reason why it's $110,000 is because that includes closing costs, right? Title escrow, mortgage insurance, etc. And there's your growth rate you could see at 4.815, and there's your line of credit of $145,000. Each horizontal line represents a year. So 1 year going by, 2 year, 3 year, 4 year, 5 year, etc. Look at year one. In year one, you see where it says MIP. That stands for mortgage insurance premium. That person has deferred $562 in mortgage insurance for the entire year, and they've also deferred $48.53 in interest for the year. If you add the two together, that's the total deferral for the entire year. Therefore, their balance goes from $110,000 to $115,415. So they had $54.15 in growth for that year in balance based on deferred interest, assuming they never made a payment, right? But look at the line of credit now. The line of credit started at 145, and now it's at 152, 138. So they've gained $7,200 in growth. That is pretty cool. Now the house has a appreciation rate of 4% on it. So instead of a $500,000 house, now the house is worth $520,000. Now, even if the house didn't appreciate, that growth on the line of credit would still be there. And as it grows, it locks in at that amount. Now, what you do at that point is the borrower may want to pull some of that money out. It's there. It's up to them. They can pull out $2,000, $5,000, $50,000. We don't care. Just know that whatever they do borrow will become part of the balance bucket, right? It'll increase your balance. Therefore, you will start to defer more interest. So that's why the line of credit, to me, in my opinion, is the best route to go. So obviously, if you have to take lump sums at closing and do things like that, I get it. Or if you don't want to overfund and you want to have the cash in your possession, I get it. But this is a way to make the loan work more efficiently and preserve more equity for the future. Okay, so pretty cool. Look at year 10, right? Year 10, the balance at that point is 177 based on 10 years of deferred interest and MIP. Look at that line of credit, $234,000 line of credit. So whatever you leave in the line of credit assesses the growth rate. Whatever you pull out does not, of course. So be conservative with it. Pull out only what you need. I've seen borrowers do this, which is pretty cool. Every year, property taxes are due, and so is your homeowner's insurance premium. They pull just that amount from the line of credit and pay those items. And guess what? Next year, the growth is back again to pay those items again. It's a way to use that to pay those expenses as well. So this is how you make a reverse mortgage work very well. We call it overfunding. It would be the same idea as if you were buying a house with a regular Fannie Mae or Freddie Mac loan, where you got to put down 20% to avoid mortgage insurance. You take a loan for 80%, right? Maybe I'm like, well, I have more to put down, so I'm going to put more down. And when I put more down, it's going to decrease my loan amount. Therefore, I have a lower payment, lower interest. The downside to that is whatever money I put down, I can't get it back out unless I refi. This allows you to pull it back out without having to refinance or do any kind of line of credits down the road. It's a fluid account. So pretty cool stuff, you guys. Called overfunding. This is something that Ryan and I coined years ago. We're doing it more and more for customers as they sell their homes and have a lot of equity. They're starting to overfund to make these loans work more efficiently, better. Crystal, this slide usually generates some questions. I'm not sure if you want to see if there's anything there for me. I can't see the chat feature.
No, we don't have any questions right now.
Okay, let me drink some water here. All right, guys. I hope you're getting these concepts. They can be difficult for some people not. You know, there's numbers of people out there. And believe me, this was hard for me in the beginning when I first got started in this industry. But as you slowly start to absorb it, you can start to see how this stuff works. One of the things I want to talk about too is that, you know, after this class today, make sure we get your information because we have tutorials on this stuff and videos to keep you fresh and top of mind with this stuff, so that way you guys can have this information, because make no mistake about it, right? Over the next 10 years, 15 years, you're going to be dealing with more retired homeowners than you ever have. And the second part of class will demonstrate that to you, why that is, what's going on with a retired homeowner. So know for sure you're going to be dealing with it. People are going to ask you about reverse mortgages. It's important for you to have this knowledge at your fingertips because yes, you guys are great at your job. You can sell a house and you can negotiate great deals and help your customers out. But in addition to that, you got to be a value add to them above and beyond what your skill set is already. I make it my personal goal in life to know a lot about what my retired homeowners are going through, right? I want to know about Prop 60, 90, trusts, real estate, reverse mortgages, Medicare, Medicaid. I take time to learn about this stuff because if I can talk about it intelligently and then put them in the right direction towards somebody who's a professional, heck, I'm bringing some value to that customer above and beyond what my normal skill set is, right? I think that really stands well with this demographic, and they really love the idea that you're taking that extra step to help them navigate areas. All right, so let's move on from overfunding. Great slide. Here we go. The next one here is basically buying a more expensive house. Can you buy a more expensive house with a reverse mortgage than what you currently owe? And the answer is, of course you can, right? What I mean by this is you're not selling a home, let's say, from, you know, Beaumont in California, where the house is maybe a little less expensive, or even like Baker, California, or any other more of an open, vast area in California, and buying in Newport Beach, right? Or even La Jolla or whatever. That's not what we're talking about. We're not talking about selling a smaller house and buying a bigger house in those areas. What we mean is you're selling a house that's dilapidated, that's got major deferred maintenance typically. You know, when you're on Social Security, it's very difficult to maintain a house and keep food on the table and do all these things. So I'm sure you guys have seen these houses. I see them all the time. So they're selling the house as dilapidated. Usually that does not go to a end user or a consumer that's going to buy it right away and live in it. Typically they're going to an investor, right? Who's going to take the house, flip it, and make that a home that they want to resell. So you have to sell those houses as is. And once you sell the house, you're not going to get the net cash that you normally would have had if you would have sold it at the higher value, price for that house. So sell the house as dilapidated. They go buy something that's turnkey, nicer, right? So that's kind of what we're talking about with this slide. I want to go through this slide pretty quickly so you guys can get the idea. And then I want to share a story with you about how this helped another customer. So here we go. Upgrading, buying a more expensive house. So let's say the customer sells their house or you list their house for $450,000. And after the close of escrow, after paying off their loan, commissions for real estate commissions, title escrow, the normal costs with real estate, a net $310,000. Well, you turn around and buy them a replacement home for $600,000. And of course, based on 72, we ask that they put down the entire $310,000. So all the net proceeds from the smaller home or dilapidated home. And we're going to obviously do a loan for $290,000. And again, I just wanted to make this clear that with today's market, the down payment and loan amount should be equal. In other words, drop down the loan amount, drop down the down payment a little bit, increase the loan amount a little bit. That's kind of where we're at in today's market, but this is an older slide, so we'll use this for the sake of today. So we give them a loan for $290,000, they put down $310,000, and voila, they got themselves a more expensive home, nicer, turnkey, remodeled, and they didn't generate a monthly mortgage payment. Pretty cool stuff. And obviously, we use this loan to increase their purchase power. And that's kind of where I want to spend a moment on real quick. Well, I may be saying this, the first one to say it, I think you guys already know this. I think we're in a buyer's market all of a sudden due to what's going on in our country or even globally. Just merely, 2 months ago, 3 months ago, it was a seller's market. It looks like it's starting to switch over the other route. I could be wrong, I could be right. But sometimes when you have a listing and you're not getting any activity on it, one of the things you typically have to do, which is a hard conversation to have with the seller, is the old, I got to reduce the price to generate more activity, right? Very tough conversation to have with the seller. I feel for you guys when you guys have that conversation. It's a tough one. But I have seen agents use this reverse purchase to soften the blow a little bit, if you will. What I mean by that is if you're decreasing somebody's house listing price or the sales price, they're going to net less equity, which in turn is going to decrease the amount of house they can buy. And they really relied on that equity to buy the house they're looking for. You can use the reverse purchase to kick up that purchase power on the house they're buying, still not generate a monthly mortgage payment. And again, they don't have to borrow all the money. They can overfund and do all these things to have a small balance just to get them to that next price, right? So it's a way to use this to increase the purchase power of somebody. So cool strategy. I've seen other agents use this to soften that blow. So pretty cool. Next, again, we talked about FICO scores are not considered in limited income. Now, what I want to talk about, the story that I was just mentioning a minute ago. So after doing these classes, you guys have been doing these classes for probably 8 or 9 years now. Met a lot of realtors. One realtor in mind stuck out to me all this time. And this guy was working, he was getting basically pre-foreclosure data. He was getting all sorts of distressed property data to go try to find these listings. He was having success with that. He was helping customers stop foreclosures and do things. And of course, he couldn't get them all because when you're in that situation as a homeowner, you don't want to necessarily sell your house even though you're having an issue because you're fearful where you're going to live, right? And that was the problem that he was running into with some of the people. He was trying to figure out ways to still have them buy a replacement home. He wanted to finish that transaction, put a smile on their face, and help them out. He felt very connected to these people. So what he ended up, once he took our class, I think I remember the days vividly, you can see him just perk up in his chair. He started thinking, well, geez, this is an opportunity for me. These guys are telling me that you can have bad credit, you can have limited income, and have just some home equity from the house I'm selling, and they can go buy that replacement home. And that's exactly what he did. So what he started doing was he started getting that data, the pre-foreclosure, and then driving the neighborhoods, door knocking, figuring out things. And lo and behold, he was starting to realize that a lot of the homeowners that were in default and having issues were retired, and they were over the age of 65. And so he would basically started changing his branding or his messaging a little bit. Hey, I can help you sell this home that's going into foreclosure, that's dilapidated, and get you to a replacement home that's nicer and not generate a monthly mortgage payment. And of course, he started generating conversations. Within 2 weeks of taking our class, he had a conversation with a homeowner, and lo and behold, calls us up and says, hey, I have something here. This person's in default. I can stop the foreclosure by listing the house, and I think that this product will help them get to a replacement home. So he set the appointment. We met with the customer. After interviewing the customer, we learned why they were in foreclosure. And basically, it was because they were battling their siblings on their parents' house that was in foreclosure and in probate. Excuse me. It wasn't her house. So what happened was she had lawyers. All the family had different lawyers, and she had exhausted her savings, and all of her money went toward legal costs to fight her siblings on this home that was her parents'. So she defaulted on her loan on her house, and she was about 6-7 months in the rears on that, which she couldn't come out of. So she was going on foreclosure. So the realtor's like, well, okay, sounds like we have a valid reason. I'm like, yep, she's got legal issues. I can explain that with a letter of explanation. I can show the attorney bills, and all that mortgage late problem, I don't care about. So we're good to go on that. I qualify there. She's got good income. She's got Social Security of about $1,300 a month. Let's do this. Told the realtor, can you find her a replacement home for this price? He said, absolutely, I can. So he went out, found the home, wrote an offer, got it accepted, stopped the foreclosure, sold that house that she was living in to an investor for as is, with just enough cash to make the cash for the down payment on the replacement home that she bought. All the while during this transaction, the homeowner was basically like, I just can't believe this is happening. I'm waiting for this to fall apart. She's looking at us like we're crazy. We're trying to do something that's impossible here, because all the other people that she had talked to had no solution. Well, lo and behold, even at the final close of escrow, she's signing loan documents. She's like, I still don't believe it. I guess I'll believe it when I get the keys. Well, a couple days later, she gets the keys. She moves in, turnkey property, just remodeled from an investor, beautiful home. And guess what? Here's the best part, you guys. The homeowner, she had health issues, respiratory issues due to mold and things in the house. Guess what? All that went away. Her health increased. Her demeanor, her life, everything got better, which was very moving, so to speak. This is why I do this job. This is why this realtor does this job. And guess what? Did we all make money on the transaction? Did the realtor get a listing and a buying opportunity? Of course. That's great too. But the best part is, like I said, is helping that homeowner get into that next home, which was amazing. That's one of the transactions vividly that stands out in my mind the most. And there's more of those out there, you guys. They're all over the place. They need your help. Maybe the reverse mortgage isn't the right idea. Regardless, there's people out there living in homes that need to buy the next home. And you guys are the people that are going to help them. Okay. Not so much their financial planners anymore can help them. You guys, the realtors, are going to be out there helping all these retired homeowners get to their replacement homes, living a better life. And I thank you for that. All right. Moving on, you guys. Let's go to next slide here. So this will be the last slide. We'll take a quick 5-minute break just to kind of stretch our feet. I need to drink some water and get up and walk around for a minute. However, this is the first time out of my house. I'm at the office. I'm here by myself. It's great. I love it. It is nice to get out and do some live streaming with you guys. I appreciate you guys showing up today. So let's go through what you need to know before you write an offer with using a reverse mortgage for purchase, okay? All right, so pre-underwriting, so important, you guys, for the first reason. One, when you're trying to sell a retired homeowner's house, I would hate for someone to sell their property and not buy a replacement home, right? This is our retirement population. These are our seniors that need to make sure that this is going to happen. So pre-underwriting is so important. I can't explain it how important this is. So the way it usually works is you guys identify the customer, right? You're like, hey, Rob, I got somebody here. I think the reverse purchase could work. They're interested in listing and buying a replacement home. Can you come out and meet me with my customer? Absolutely. This is a face-to-face business, of course. However, given today's circumstances, it makes it difficult. So, but typically, it's a face-to-face business. So I would meet the customer in person. You're there, I'm there, or Ryan's there, or whoever, and we're going over the transaction. We're getting all the areas of concern worked out. I'm gathering income. I'm doing things. I'm making sure that they can qualify. Once I got a complete package, I like to submit this to an actual DE underwriter, a direct endorsement FHA underwriter, to get everything worked out. We're pulling credit reports, property tax payment history, doing all the necessary due diligence to make sure that we've addressed every issue so we qualify. Once I give you that pre-underwritten letter saying they can buy a house at this price, is it 99% accurate and true? Yes, of course. But there's things that always can pop up. These are loans. You guys know real estate. Things pop up on title. All kinds of weird things happen, right? But just know for sure that we spend a lot of time doing pre-underwriting. We want to have a customer that's done, ready to go. So you guys are out there writing offers, listing their house, getting it done. We know we have a very highly likelihood this thing's going to go through. I haven't had one fall out yet, so hopefully that's keeps going. So pre-underwriting is a big deal. The next thing that's a big deal is the client must undergo reverse mortgage counseling. And this has to be done prior to an appraisal being ordered. This step should be done right away. So when I'm out at their house or delivering them a proposal, I'm giving them a list of counselors. They choose one from the list. It's a third party, has nothing to do with us or anybody else. They are licensed by HUD. They're nonprofit, and basically they educate the borrower again about how the reverse mortgage works and go over all that stuff. So it is a layer of protection between the lending industry and the homeowner for great reason. Again, we're dealing with retired homeowners here. They need protection. A lot of elderly abuse out there and all sorts of things. So very important, right? So they go through the counseling session. Once they pass it, then they get a counseling certificate. This is usually done over the telephone. It's a cost to the homeowner of about 125 to 150 bucks. And they go through the session. They usually last about, I would say, 45 minutes to an hour. It is a pretty easy step to get through, so I don't want to make it seem like it's hard. It's pretty easy, but it must be done before we can order an appraisal. And of course, when you write an offer and you get it accepted on the house they're buying, the first thing that happens to me is I get a call from the listing agent saying, when are you ordering the appraisal? And of course, if they haven't done this step yet, I can't order the appraisal. So very important we get that knocked out right away. So ideally, pre-underwriting up front, get them into counseling ASAP. The counseling is valid for 6 months. So you have 6-month window to get them into an escrow somewhere in the house they're buying. And we provide that list to the customer, of course. So pretty easy there. We get all that knocked out in the beginning. These loans can't have any concessions. So you guys can't credit any of your commission towards the buyer. The seller can't credit anything. This can happen. This happens sometimes on transactions where maybe there's a repair that needs to be done in the home. And the seller's like, hey, I'm okay with that. I don't want to repair it myself, so I'm going to go ahead and give you $5,000 to repair it yourself. Well, that's a concession. So there is ways to work that out. You can decrease the purchase price by $5,000. You guys work that out. I'll leave that in your court. You guys are the pros on that. You guys have been doing real estate for a long time. You guys know the contracts and how to make that work. A A concession, by the way, can also be considered personal property. For instance, a transaction I had years ago where the customer was buying a golf course home out in Palm Desert. And along with the golf course home, of course, came a golf cart. And not just a golf cart, an Escalade golf cart, like a Cadillac Escalade golf cart. Pretty nice, right? The homeowner wanted it. I wanted it too. So they gave it along with the house to the homeowner, except it was given value. That was the problem. So what the agents did was they wrote an addendum to the purchase contract and said no value given to the Escalade golf cart, and we got through the issue, no problem. And that could also be, appliances on houses. You guys know the difference. Again, you guys are the pros between personal and real property. You guys can determine that, but no concessions whatsoever. Okay. And this could change. So I know that our industry, the reverse mortgage industry, advocates for our retired homeowners in the respect that, hey, who should get a concession? Me at 45 years old when I'm buying a house, who's still working, who still generates income, or a retired homeowner? Should they get a concession? Doesn't make sense to me. I feel that our retired homeowners should get the concessions, right? So just the way it is. I think the reason why HUD does that is because they want to make sure that the retired homeowner is buying that replacement home based on good reasons and not like receiving something that's really arbitrary compared to the overall bigger picture of the transaction. So that's the only reason why I can suggest that, but no concessions. Next, when you guys write your initial offer, make sure you guys include the FHA mandatory escape clause. This is in your WIN forms or your ZIP forms. It's in the FHA section, and just include that with the initial offer. It must be signed by all parties: listing, buying agent, sellers, buyers, etc. So we usually make sure you get that out there with your offer. And of course, if you guys have any questions before you write an offer, right? And I'm going to highly recommend you do this because we want to make sure, again, we get them pre-approved, we get them into counseling. So if you have a question or have any kind of thing you want to talk about regarding a transaction, that's a 888-242-5959 number. That number is only for real estate agents. It's a realtor hotline. When that thing rings, it hits our office and it hits our cell phones. If we don't pick it up, I'm going to be a little bit bummed out because it's important that when you guys call, we know that we grab the call. We know that you guys are most likely with a customer or have a really urgent need that you need to have handled. So we will pick that number up immediately and help you guys out any way we can. Of course, our emails are on the presentation as well. So at this point in time, I would like to take a 5-minute break. And then
I'd like to just to interrupt. We actually do have a one question.
Cool.
So the question is, with a reverse mortgage, can I do a VRBO for 5 months per year?
I would say no, because now you're using it as a business. And I would say no. I can get clarification on that, but I do believe a VRBO would definitely cause some feather ruffling at the HUD level, for sure.
Okay, perfect. So it's 11:18. We can break for about 5 minutes. So we will return at 11:23 and continue with the webinar then.
All right, guys, I'm going to stretch my feet. I'll see you in 5 minutes.
Okay, so it's 11:23. We're going to go ahead and continue the webinar, and there will be, it should be ending at 12:30, so we have just a little bit more than an hour left to go over a couple key points. Rob, you can go ahead and continue the presentation.
Thank you, Crystal. All right, let's talk about some growth and key facts. This whole next section will go pretty quick. It's all about, what our retired homeowners are facing currently. So let's dive right in. You guys have probably seen this statistic before, but basically 10,000 boomers turn 65 every single day. So when you woke up this morning, 10,000 boomers turn 65. And guess what? That'll happen again tomorrow, and so on and so forth. It'll happen for the next 10 years. It's 2020, so it goes to 2030. In addition to 10,000 boomers turning 65 every day, I also read that 10,000 boomers retire every day, which is interesting. Because the data that I read illustrates that they're not ready for retirement. So after doing a lot of research and poking around and doing all the things I normally do when I come up with these data points, is that the only thing I can understand why they're retiring is because they're just tired of working. And I don't blame them. I mean, look, I'm 45 years old. I'm not tired of working yet, but if I'm 75, I can certainly see how I might be. The difference between myself, for instance, and a retired person is that I have a longer period of time to retire or to make money and do things. So, try to make up for my retirement. But if you're forced to retire or want to retire, when you're in your 70s or early 70s, I can see how that could be an issue. So we have a lot of boomers out there, a lot of them turning 65, a lot of them retiring. So that's something to definitely focus on. We have 80 million boomers in the country, ranging from the ages of 56 to 76. So that shows you the age span. That's a lot of people. And by the way, if you factor in their parents, the silent generation, that's got to be near 100 to probably 120,000, 120 million people. That is a lot of people in our country that are retired, that own houses, all kinds of things, right? So it's definitely a good number to know. 45% of our boomers out there have no retirement savings. The other 55 are boomers, 55%, have some retirement savings, and 28% of those 55 have less than $100,000 saved in retirement. So what this is telling me that a big chunk of our retired homeowners are living on Social Security alone. Now, I don't mean to pick on the boomers about retirement. My demographic, the Gen Xers, we're not saving enough in retirement either. And neither are the millennials, anybody for that matter. Everybody, if you look at the numbers, it's scary out there how we save for retirement, right? It's very difficult. And this didn't just happen overnight. What happened was, see, I'll talk about that in a second, but things change in how we retire. But let's talk about Social Security real quick. The average Social Security check out there from 2019 was $1,461 per month. So that just tells you right there that when you retire, you retain more of your expenses and you have a huge reduction in income. That's tough, right? If you're going from a job situation and you retire, now you're solely on Social Security, but you still have all your expenses. And in some cases, you probably take on more expenses, right? If you have a health issue, things like that. So that could definitely pose some issues for retirement. Like I said, the whole retirement thing didn't happen overnight. What happened was, you see, when my dad retired from the workforce, he got a full pension. In other words, he retires and his paycheck that he got every 2 weeks or every month for that matter from his employer never changed. It just kept coming, right? Same paycheck. So he never really skipped a beat. That's because he had a pension. Well, back in the 80s, a lot of the big companies started removing the pension plans, introduced the 401k. That obviously affects our boomers, right? Our boomers don't get the pensions that their parents had, but they have this 401k vehicle where they can take part of their paycheck, put it into a 401k, tax deferred, and the employer will match them 6% in some cases, which is great. But it's hard to save for yourself, right? You have expenses, mortgage payments, all these things, and there's rarely a time at the end of my month where I'm looking at my bank statement going, well, I got more cash than I had the month before. That's not usually the case. Usually, the water pipe breaks. I got to have my house repiped. The water heater goes, or this or that, or life gets you, right? And you got to spend money somewhere else, right? So that was a big change in our retirement strategies. The 401k came out. Good idea, but it's hard to put money into those things and save. And then the stock markets are going up or down. It's very difficult. One thing we do know for sure is that our retired homeowners own property. That's a great thing. Those homeowners did such a great job. They bought houses, they paid their mortgage balances down, they did all kinds of stuff. So what that resulted in is a lot of their wealth that they have is held in their home in the form of equity. The challenge becomes, how do you get to that equity, right? How do you access it safely so that way you can sustain retirement and not put yourself into jeopardy of becoming homeless or losing a house? Well, the reverse mortgage, the refinance product is one way to do that, or to sell your house is another way to do that. But when you sell a house to try to find that replacement home, it can be difficult when qualifying for a loan. That's where the reverse purchase could come in. So if you look at the numbers here, our retired homeowners have over 7.14 trillion in homeowner equity nationwide. That's a lot of equity. So that tells you where all their wealth is at. So it's more upon the real estate agent now than it is their financial planner to help them with their retirement needs. You guys have real estate licenses. A real estate planner does, a financial planner does not. So you guys now are holding the keys to the castle, so to speak, to help them access that equity, either by selling their houses to buy a replacement home, giving them the information about a reverse, whatever that is, whatever the case may be. Their wealth is in their home equity, and you guys have a real estate license to help them navigate that conversation, which is cool for you guys, right? So the next thing you want to know, so we know that we have boomers that have retirement issues. We know that they're living on Social Security alone. We know they have a lot of wealth in their homes. We know that they need to get to that wealth. Some other things we need to know is, where do they live, right? So, of course, they live in the red states here, as you can see. Now, this was as of 2012. We have a new Census Bureau that's being worked on. I don't think it's out yet. So we'll have some new areas of where people are moving to now after the new Census Bureau data gets released. But back then, 10 years ago, the three states were California, Texas, and Florida. California houses most of our retired population, obviously, because I would assume, not because it's cheap to live here, but because the weather's great, right? And it's a state they've lived in for a long time. So we got 4.6 million retired homeowners age 65 and older in California, 3.5 million in Florida, and 2.8 million in Texas. So Texas and Florida are great states to live in, but they have their own set of issues. Florida gets hurricanes, Texas gets tornadoes and hurricanes. We get earthquakes. We all have our own issues. I choose earthquakes, by the way. So living in California is expensive, though. That is a challenge. So that's where accessing that equity and doing it safely can help out for someone to stay in California. This product, by the way, reverse mortgages, the HECM product is available in all 50 states. So if someone wanted to sell in California and move to, let's say, Arizona or Idaho, they could do that as well, and their dollar would go much further. They can do that. So we know where they live. They live in California, which, by the way, that's where you guys are licensed. So that's cool. Next thing you want to know is when, right? When should you start to, or excuse me, I'm sorry, what age of our retired population are starting to make fundamental decisions about their real estate, about their equity, about reverse mortgages? Well, our chart is right here. And one of the things that, I tried to find this information through the National Association of Realtors and also California Association of Realtors. They have some great data, by the way. So highly recommend taking a look at that. But one thing I came to realization is that when you guys do a listing agreement or a residential purchase agreement, you guys cannot ask them how old they are. And so you guys really can't keep good data on that, right? However, my industry, we have to know their age because their age tells me how much they can borrow. So my industry tells me that 42.10% of my borrowers that are either using a reverse mortgage for purchase or a reverse mortgage refinance are from the ages of 70 to 79. That's why in the previous slides I used that age, because that seems to be the sweet spot for our boomers. Well, guess what? Our oldest boomer turned 76 years old this year, the higher end of the boomers. That's right in the middle of those ages. So you can start to see what I'm building here. I'm building a puzzle. I'm building a recipe, if you will. We know where they live. We know at what age they're starting to make these decisions. We know where their wealth is at. We know they have some retirement issues. Starting to see the light here as to where a lot of the real estate transactions are going to take place. That's going to be with our retired population. Let's go to the next slide now. Let's talk about, so that's the end of that little section there. I just wanted to give you an idea of basically how and what our retirement population is facing and how you guys could be of service to help them. The market's there, you guys. It becomes a situation is how do you spark up these conversations and how do you stay in front of them, right? Very important. But let's talk about what happens in the future with a reverse mortgage. Very important topic. A lot of customers will want to know this information. So here's what happens in the future with a reverse mortgage. There's two likely outcomes down the road when the homeowners pass away. The first, above water, meaning there's positive equity, and the second, meaning underwater, negative equity. Both are possible, of course. Well, let's dive into the above water situation. Here's the heirs options after all borrowers have passed away. If the heirs want to keep the house, they're more than welcome to do so. This is just a loan on title like any loan out there. So the heirs would simply pay off the balance either by refinancing it, which is another loan, cash they have on hand, or a combination of the two. They pay off the loan, they keep the house and the equity. So there's $200,000 in equity there. No problem. Pretty straightforward, just like a regular mortgage. If the heirs don't want to keep the house, they don't have to. They can sell it. They would simply hire you, a real estate agent, sell the house, pay off the reverse mortgage balance, whatever's left in equity, they would take and split it amongst the heirs. So in this case, to keep the number simple, they would pocket $200,000, and that's their net equity after they sold their parents' home. Pretty basic, right? Just like a regular mortgage. The other thing they gain, so here's how this works in an underwater situation. This is where it gets a little bit more interesting. If the heirs want to keep the house, oops, I got to go back here. I'll just leave it up there, no problem. If the heirs want to keep the house, they can do so. And here's how it works. Due to the house being underwater, FHA or HUD has a rule that's called the 95% rule. This means that if the heirs want to keep the house, they can pay off the balance of the mortgage at 95% of the market value. So in this example here, the value of the home is $300,000. The reverse mortgage balance is $400,000. So the payoff to keep the house would be 95% of 300, which is 285. So 285, they pay it off. They keep the house with 5% equity, and they get the house, no problems, no issues. You're probably wondering, well, what happens to the other $115,000 that was owed on the mortgage? Well, that's where FHA comes in. FHA insures the loan, so they make it they pay an insurance claim to the lender for the difference. And everybody parts their ways at that point in time. So that's what the insurance will do, is it will cover the loss on the balance to pay the lender. So the lender gets made whole, FHA pays the insurance to them to make them whole, and the heirs get the house at 95% of the market value. That's if they want to keep it. If the heirs decide they don't want to keep it, then they can simply do nothing and let the home go to foreclosure. This is a non-recourse loan. So they walk away, the house will go into foreclosure, because the reason why it goes into foreclosure is because they violated a rule, which is occupancy. The homeowners are deceased. So they're no longer owner occupying the home. And so the house gets foreclosed on, heirs walk away, no recourse. They will not send any kind of judgment against them or 1099 for the loss or any weird thing like that. There's nothing like that. House gets foreclosed on the way a normal house would get foreclosed on. Notice of default goes out. Nobody responds to that. Notice of trustee sale, NTS. Nobody responds to that. House goes to the auction. House doesn't sell at auction, then it goes right back to the bank as an REO, real estate owned, and voila, foreclosure, just like a regular mortgage. The heirs are not hurt any way, shape, or form. And even if mom and dad owned other houses or had cash in the bank or anything like that, all untouchable, not a problem. So the house gets dealt with through FHA and the insurance on it from FHA. Pretty basic stuff. The next thing they can do is, if they didn't want to take advantage of the 95% rule, let it go to foreclosure. They can also hire an agent, a realtor, to short sell the property. So that would work just like a regular short sale. The appraiser would determine the value, and then whatever the loss is would be that would be covered by FHA. So short sales are fine. No benefit really to the heirs of the deceased homeowners. So I have heard of agents out there that focus on doing short sales for reverse mortgage deceased borrowers, and I heard they're pretty basic to get done. It makes sense to me. I think that it would be better for these houses to be sold in the open market to lessen the blow to FHA, if you will. So maybe short sales are something that's more advantageous for them to be completed as not. So pretty cool stuff. Those are the two options: above water and underwater. The 95% rule, once I tell homeowners about that, they're like, oh, that's pretty cool. I didn't know that insurance could cover that. That's exactly what it does. So that's what happens in the future. Let's move on to some reverse mortgage myths. We'll get through these really quickly, and then I want to get you guys, remember, to the parts where we talk about how to find these listings, right? How to identify these customers that can help you or get into your pipeline and help you generate some activity. So do you guys think the government or bank owns the house when you get a reverse mortgage? The answer is no. The government or bank does not own the house. The homeowner does. So like a traditional mortgage, you pledge your home as collateral while remaining the sole owner of the property. So all it is a loan on title. Well, I and my heirs lose future appreciation in the home. If the house gains in value, then great. That's all appreciation that's happening on the house, and that can all be passed down to the heirs. So appreciation is not owned by the bank or the government. It's all owned by the heirs or the estate. My heirs can't inherit the home after I pass away. Well, we just figured that out, right? Of course they can. This is like a regular mortgage. Of course they can inherit the home. However, if the house is not in a trust, whether it's a reverse or not, it's subject to probate in the state of California. So that could cause some issues, but they can still get the home down the road after they go through probate court. But, just the basis is that they can inherit the home after they pass away. How the house is passed down is determined upon their estate planning. So with or without a trust, we can do reverse mortgages. We prefer trust. I'm 45. I'm not planning on passing away anytime soon. I do have a trust in place. I've seen the horror stories, and so I think a trust is probably the best way to go for any type of loan or any type of house that you own. If my house ends up being underwater, am I required to leave the property? Can I no longer live in my home? Well, regardless of the value, regardless if it's underwater or not, or the balance, as long as you're obeying the rules of the reverse mortgage, which we're going to cover in just a moment, the loan will continue in good standing and you can live in the house the rest of your life. So independent of values and what the balance is doing. So I don't care if your balance is 800,000 and your house is worth 400,000. Still get to live there as long as you're obeying the rules of the loan. What are the reverse mortgage borrower's obligations? This is the rules I'm talking about. Let's talk about the first rule. Again, this is an owner-occupied loan, so you got to remain in the home as your primary residence. Sometimes when you're older, you may get some sort of issue like Alzheimer's or dementia. Maybe you're the last spouse in the home or the last remaining borrower in that property. If you go outside the home to get care due to one of those elements, that could possibly be an issue. What I mean by that is FHA has a rule that if you're outside the home for more than 12 months, the house needs to be, or the reverse mortgage needs to be paid off. And so that could be done by either A, selling the house or refinancing it. This has to be paid off because you're no longer living there, right? You're in a nursing facility for that matter. But every now and again, the family may say, hey, let's bring mom or dad or whoever's in that home back to live in the property. And if they bring them back to the house within 12 months, then the clock restarts and they're still in good standing with HUD. So what I'm saying is that if they're outside the house for more than 12 months, the loan should be paid off either by selling or refining. If they go into the facility and they come back within 12 months, the loan's in good standing. How you document that is simple. When you go into any kind of a nursing facility, there's inbound paperwork. When you come out, there's outbound paperwork. If that paperwork is less than 12 months, well, then you can show that to HUD and you're in good standing and the loan will remain in place. If it's outside of 12 months, then you need to refi or sell the property. So this is a potential issue. Now you're probably wondering, well, how do they know if you're occupying the house or not? Well, here's how. For sure, they send out a letter every single year asking the homeowner, do you live here? And you simply say, yes, I do, and you send it back. Once they get the letter back, you're good to go. They'll send another one out the following year, so on and so forth. If they don't get the letter back, then they get a little concerned. They're not going to send anybody to your house or do anything like that. They'll start to poke around a little bit. One of the things they do is you have to have a alternative contact person on the loan. And that person may get a call from the servicer saying, hey, we didn't get our occupancy letter back. Where's so-and-so? Oh, they're on vacation. They'll be back in 2 months. No problem. Have them send us that letter as soon as they get back. Okay, great. Or maybe they'll start to look at property tax bills, right? That's all public record. They can pull that up. They can say, okay, well, the property tax bill is being mailed to the Bahamas. Good chance they're not living there. They may trigger some other ways they're going to investigate. So the moral of the story is you got to reverse, live in the house as your primary residence. Okay. So that's rule number one. Rule number two, pay property taxes, homeowners insurance, and HOA fees if you have them, or dues rather. So after you get the reverse, you still have these costs. You have to pay the property taxes, you got to pay homeowners insurance, you got to pay the HOA fees if you got them. If you default on these and you can't get caught up, then they have the right to foreclose on you. And so I would say the majority of foreclosures that we see in our industry are due to property taxes. Now, I'm going to touch upon this briefly because I don't want to run out of time. I want to get to the good part of the class about how to find the customers. But before 2015, you never had to show income to get a reverse mortgage. So even if you had no income, you can get a reverse, but you still have these ongoing costs. Once you run out of reverse mortgage proceeds, and now you have property tax bills that are piling up, you're going to get foreclosed on. That happened in the past. But in 2015 to date, we now underwrite with income to make sure that these items can be paid for with your income after you get the reverse. So that's a good thing. So now we underwrite and make sure you can qualify based on your ongoing expenses. So the defaults are much far less these days. I would say we're starting to see more probably owner occupancy defaults because a borrower passes away, servicer doesn't find out, kids are living in the home, and eventually they find out and then foreclosure begins. So paying your property taxes and homeowners insurance is a big deal. The last one, maintain the home to minimum FHA standards. Well, what does that mean, right? Well, there is a list of these standards on HUD's website. You can read them and get a good idea. but it's usually the basics, right? So what we tell our customers is this. At the time you got the reverse mortgage or the reverse mortgage for purchase, there was an FHA reverse mortgage appraisal done. If that appraisal comes back as is, in other words, it meets HUD guidelines or FHA guidelines, you're good to go. And they're looking, not only are they looking just for value, they're also looking for any health and safety related items. And so if they say as is, then it's met HUD's guidelines. And if you keep your house in that condition, don't let it get below that condition, you should be in good shape. So in my career, I haven't seen anybody get foreclosed on, at least my borrowers for that matter, due to condition of property. Usually in the past, before 15, was due to property taxes, or recently could be because maybe they passed away and the house is no longer owner occupied. So those are the main rules to keep a loan in good standing. Okay, let's move on. Let's talk about the calculator. Okay, so again, every age is a different calculation. So that's why it's important to have this. We made this app for you guys to have on your phone. So the reason why we made it is because we figured if you guys are in the field and you're at a listing appointment and you're showing a customer, hey, this is your net proceeds after I sell your property, and the customer might be saying, well, what can I buy with that? That's not enough to go buy my house, and I don't want a mortgage payment. You can then start to play with the numbers in the app to figure out what their purchase power can be based on their ages and what the available proceeds they have, either from their house that they're selling or cash they have on hand. So that way you can kind of get the customer to say, oh, okay, I get it. Then we can talk about how the loan works and all that stuff. This is a good way for you to know that you have an option here for your customers to repurchase a replacement home. For married couples, you only want to put in, so only one spouse has to be 62 and older. The other spouse could be 55, for instance, right? So you want to put both ages in there. Put the one age of the qualifying borrower and then put the other age of the youngest borrower. What will happen is the app will calculate the loan amount based on the youngest spouse. For instance, if you have a borrower that's 62 and the spouse is 55, the loan amount will be based on the 55-year-old. And the reason being is because they have the longer life expectancy technically, right? This was a huge change in our industry. Years ago, that borrower that's 55 years old could not be on the loan, could not be on title, and not be recognized. But the qualifying borrower, maybe 15 years down the road, would pass away. Now the loan gets foreclosed on, and the person that is left behind is like, well, wait a minute, I live here. I was married to that person. Don't I get to stay here? And the answer is, of course, you can stay there, but you have to pay off the loan, which can be difficult to do down the road. With this new rule that came out, gosh, it's probably been at least 7 years now. If the borrower at that time did the loan, they were 62 and the other spouse was 55, that 55-year-old is protected to live in the house for the rest of their life because we base the loan amount on their age. So that was a great change in our industry. So that's a very cool thing. That got changed in our industry. However, there are people that got loans from the past that are not on title. I believe that majority of the servicers now are letting those folks come back on title and be protected. So that's a cool thing. If you ever come across that situation, try to advise them to get back on title. Next, for unmarried borrowers, all borrowers need to be 62 and older. So if you have 3 borrowers that are not related to one another, you have a 62-year-old, a 65, and a 70-year-old, for instance, they can all go on the loan together, but the loan amount will be based on the youngest of the group. Okay? So everybody's got to be over 62. Last but not least, in the app, 765,600 is what we refer to as the max claim amount or max purchase price. Let me illustrate what this means. The FHA loans for a regular FHA mortgage, which is the first-time home buyer, the one with mortgage payments, that is the highest loan amount or the max loan amount they can receive, 765,600. In the reverse mortgage, the FHA reverse mortgage world, this is the maximum value at which we'll calculate our loan to values on. Let me explain what that means so you're super clear. let's say you have two borrowers. One borrower, they're unrelated to each other. One borrower is buying a house right at 765, 600. And then maybe another client is buying a house at $900,000. And they're both 70 years old, unrelated. Each borrower is going to get the same exact loan amount. In other words, we're not going to increase our loan amount for the $900,000 person because we only recognize 765, 600 as their max value. They can still buy that $900,000 home, but they're going to have to put down dollar for dollar down payment above that 765 number to make it work. So of course, the person that's buying the 90-year-old or the other $900,000 home is going to have a more expensive payment, or excuse me, down payment rather. So 765, 600 is the max claim amount. Next, but not least here, is anything over 850. That's where we are going to want to look at the private product. Now, this is the non-FHA stuff. This is the stuff that handles those higher valued homes. For you guys out there in San Diego, you guys got some high valued homes there in North San Diego. So those homes, you probably want to start looking at the private sector, the non-FHA reverse mortgage, which is usually anything over 850 or greater. However, due to market conditions right now, the market's very volatile, the stock market, and some of these products may be on hold until we get through this crisis that we're in. So as of right now, we have these products, but who's to say next week or the week after? That's the private sector. I don't think the FHA product's going anywhere anytime soon, so we're good there. All right. Now, moving to the next thing. This is the part of the class that's going to help you find some extra transactions. Okay. We have a website that's called gocordum.com. You can see it right there at the top of the screen. This is an exclusive website for real estate agents that have attended our class. So if you attended our class today, you get access to this website. What this website does is, let's say you have a customer right now that's in your book of business or your sphere that you've been talking to for quite some time, and they're looking at possibly listing their house, and you just not sure how to get them to move on and to make that listing happen, or even for that matter, stay in front of them properly. So when they do make that decision, that they come to you for the listing, right? This is what the site does. GoCordum.com allows you to take that customer's information and put it in there along with yours. Once we get that information on our side, we're going to review it, and then we're going to start to send them letters, newsletters from you about things like Prop 60, Prop 90, transferring your property tax base when you do decide to sell. We're all geared to give them information about selling their home, about capital gains, about where other retired homeowners like you are purchasing. All kinds of things, right? So this is a way for you to stay in front of them without doing anything. The best part is each time a piece of correspondence goes out to them, you get alerted of it. That's your opportunity to pick up the phone and call them and say, hey, I just wanted to follow up with you and make sure you got my last newsletter that I'd sent. What did you think about that? Did you have any questions about capital gains or property tax transfers and whatnot? That's a way for you to talk to them again, build that relationship even further. You're being a value add to them, right? So pretty cool. We do this all for you guys. It's complimentary. As long as you've taken our class and you don't abuse it too much. In other words, we don't want you to pull down a list of 50,000 people and throw it in there. It won't get through. We won't let it happen. But if you're putting good quality people in there that you have relationships with that are already considering listing and you want to get that thing, stay in front of them, this is a way to do it. And it's easy for you guys to do it. So here's how it works. So basically that first bullet, know an older homeowner right now that might sell soon, automatically send them personalized emails, letterheads, newsletters, and more. Get an email notification every time something goes out. We also will send them emails, but that does require them to opt into our system to receive electronic emails, which is, that's standard for any kind of email campaigns. They have to opt into it. But for mail, It's wide open. Materials are branded with your information, so they know it's coming from you on your behalf. We do this for you guys for taking our class. So that's one way you guys can start generating some activity right now. The next thing we do is we have a software called Title Pro 24/7. Well, it's not actually ours. It's put out there by Fidelity National Title. This is a software that you will get complimentary logins for in a software tutorial. This tutorial that you'll get will show you exactly how to build the perfect recipe to find those clients. So you'll get logins for that, of course, right after this class. So make sure we get your information towards the end of class, your email, cell phone numbers, whatnot, so we can get your logins created and get those sent out to you. So you have all this information. You get a full tutorial on how to use this to find those listings. And last but not least, we're going to give you a tutorial on how to use your Remine software. This is already available to you guys. You already have this. The software, what it does is it takes all the transactional historical data about people who have sold their homes, puts it into an algorithm, and assigns other homeowners that fit that filter process, if you will, a sales score. Now, these sales scores, you want to have a high sales score. So you take this list and you may add it to your Title Pro 24/7 list, put them together. If you have matches, you have a very high chance that person may want to sell soon. This would be somebody that you may want to go door knock or meet in person to start that relationship. And then once you started building that relationship, then you can put them and go court them to stay in front of them. And the goal is at the end of the day to get you guys some extra listings. That is the main thing here, right? Get you guys listings. If they want to use a reverse mortgage to buy their next house, that's great. If they don't, that's great as well. My goal today is to help you guys with listings. Okay, that's the main focus of today. All right. Let us set up for success. You got a business card, which obviously this is usually a class that we do in person. So make sure you reach out to us. You have our emails. You have everything on there to give us your information. You can fill out a form there on the site. I think Crystal is going to post a link in the chat right now for you guys to be able to fill out a form to get access to Cordum, Title Pro 24/7, get your complimentary logins there, and all these things that we offer, all the video series tutorials to help find these listings and help our retired homeowners get to that next home. Crystal,
Yes.
you there?
So link is in the chat, www.thereverseeducators.com, and you can sign up at that link to receive your logins to Title Pro 24/7, receive access to Go Cordum, and all the tutorials that we talked about for the software like Remine and the Title Pro. So that link is in the chat. You can just go ahead and click it, or the copy of the PowerPoint that was sent to you by North San Diego County Association of Realtors. It has our website and all of our contact information at the front of the PowerPoint.
Okay, should we take some questions if anybody's still there?
We don't have any questions as of right now.
Okay, all right. Well, that concludes our your listings in reverse. We appreciate you guys sitting through it. It is a long presentation to be in front of a computer. I get it, but I do appreciate it. And of course, thank you, North San Diego Association of Realtors, for hosting this. We really appreciate it. Bye for now.